Assalamu alaikum. I welcome Shayan Hamdani and other participants on this call. Shayan Hamdani is going to give us insight into financial management. And before that, I will ask Khalid Mahmood to formally announce and introduce Shayan to the forum, and he can let Shayan to get started. Khalid, is to you.
Assalamu alaikum, everybody. We are here this Saturday, February 17. सुबह के 11:10 हैं. We're still waiting for more people to come, but nevertheless, we are going to start talking about finance management, how to become financially independent. This is the topic which our member wanted to learn about, and we find an expert in residing and working in Canada, in Toronto area. His name is Shayan Hamdani. His background is from Pakistan. He spent a lot of time in Pakistan, and here, I will say, in Canada, he's with the Manulife Wealth Management Company. He's a financial advisor there. The company has more than $300 million Canadian dollars under its belt, and they help people in their retirement and tax planning and retirement planning, insurance and risk management, and others. So more we will hear from Shayan. Shayan, please say a few words if I have missed an important part of your introduction, and then we want to hear what you have to have. So our forum is Qadim University North America Alumni Associate Chapter, and we do conduct these Zoom calls every month. We try to do about 10 Zoom calls on different topics every year. So this is our second Zoom call for this year, but then at the same time, we are also having alumni elections in Pakistan, and we are helping panels of people who are running contesting seats for alumni elections in Islamabad. We are giving our forum to them, and we have conducted 4 sessions there, and we're going to have another session in 2 weeks' time. So with this, I will hand over to Shayan. Shayan, go ahead.
Perfect. Thank you. Thank you, Khalid, for the kind introduction. I'll share my screen and then do a little bit of an introduction as well, and get into the presentation. So just a little bit of background on me. I was born in Islamabad, lived in G63, went to Beacon House before moving to Canada with my family in 2006. So it's been 18 years that we've been in Canada. Born and raised in Pakistan, so understand everything about it too. In Canada, what we started with going to university at University of Toronto. Started my own practice at a company called Hollis Wealth. That's how I got into the business. Built my own practice and moved it over to Manulife. I'm a chartered investment manager. We manage over 300 million of assets. Manulife as a company manages billions and billions of dollars, but $300 million is what me and my office manages for our clients. So when financial freedom is a very vague term. When I think of, it can mean different things to different people. For a lot of people, it means it could be a number, whether that number is, $1 million, $2 million. It could be that, or for some people, it could be something a lot more, something different. Like, hey, you know what? I want to be able to be able to do things that I like, do things that I love, and not have to worry about money. No matter what your definition of financial independence is, the key thing is that financial planning is key in achieving financial independence. And the objective of this webinar is to see how financial independence and financial planning are key and go hand in hand. So
Shayan, can you put your presentation in presentation mode? or you're gonna
Yeah.
do it this way? Is your choice.
Can we keep it this way?
Yeah, okay,
Like,
that's fine.
or are you able to see?
Yeah,
Are you guys
I'm
able to see it?
Yes.
Yeah,
Go ahead.
because I'm going to keep flipping between slides, or it's not a big deal. I can change it. Yeah, there we go.
Okay, thank you.
So when I think of financial independence, there's actually 7 levels of it from a financial planner's perspective. The first thing, and they typically go hand in hand with the life cycle of a person, right? And what I mean by that is when someone graduates university and they go get into their career, they start a new job, they get married. Typically, in every single stage, there are different financial expertise that are needed. So, starting with when you first graduate, you get married, you start your career. Typically, people are in the first 3 stages of financial freedom. You start with in the clarity stage, where you're looking to figure out what is it that you're looking to do in your life, what is it that where do you want to go, and as you get into into what is it that you want to do, as you get married, you start to look into self-sufficiency and breathing room. People are typically living paycheck to paycheck, and want to be able to, see how to get into the next stage. Their goals could be anything from how to save money for a house, and whatever the goals are, there's different ways to look into how you achieve that. So, for example, let's say if someone has a goal of how to save money for a house, or for to start to fund kids' education. Typically, the areas that we'll be looking at is cash flow management, debt management, and education planning. So, and as someone has kids, another area that we would be looking at is risk management. So I'll give you an example of that. So anyone who gets married, they have a kid, some of the questions that they could have is, how do I make sure that my family is taken care of, right? That I'm in a situation where, if something was to happen to me, my kids and my wife are taken care of. So what we look at in that kind of a situation is what kind of insurance, life insurance or critical illness insurance, can be purchased to be able to provide coverage in that kind of a situation. Then as you move from, as kids get older, they get into university, and, they start to get older, people start to think about retirement, right? How much do I need to save money for retirement? What kind of rate of return do I need to fund myself and remain independent in retirement? What are some of the government pensions that I may receive? What are some of how do I make sure that my investments are managed? So typically in that kind of a situation, what we're looking at is the areas that we're looking at are retirement planning, investment management, tax planning, and these are some of the questions that people would have, right? So when you're looking at the different stages of financial freedom and how you move from one stage to another, it typically depends on the life cycle that you're at. So people that are in the getting closer and closer to retirement would typically be looking at the flexibility or the financial independence stage. Then the next stage that people get as you move into the last stage of financial freedom, which is the one where money isn't really a concern. You have enough investments to live comfortably through retirement. People will typically, the questions that they'll start to ask are, how much money, like how can I make sure that I pass what I've worked so hard for? How can I pass that to the next generation in the most tax effective manner? So, we look at different strategies for that. Things such as setting up a trust, looking at, again, insurance plays a big role in that, and developing different investment strategies on how to achieve that. I want to take this, I want to keep this kind of interactive. If you have any questions, just keep you can stop me in the middle of it and ask me questions as well. So the way, at the end of the day, there's a really famous saying that a goal without a plan is just a wish. And the importance of creating a financial plan in achieving your goals is paramount. So what do we do? Like, how do we create a financial plan? We start by understanding what are your goals and objectives. And what I mean by that is, for example, if someone's looking to retire, what we do is we take an inventory of your expenses, income, and current assets, and then we use that to create a financial plan. And then we look at different strategies on how to fund your short, medium, and long-term investment objectives. The main goal of a financial plan is to provide you with a roadmap on how to achieve your objectives and be able to look at how much rate of return you need to fund your objectives. So typically, for example, let's say the goal of someone is to fund kids' education. If the goal is to fund kids' education and all your investments are in real estate, that can be a problem, because how would you be able to fund education if all your money is tied up in an asset class that's not really that liquid? If someone has an objective of saving for a down payment of a house, and most of their money is in the stock market or in crypto, that can also be a problem because there's volatility associated with it. So, I'm creating a portfolio that caters to your particular objectives is very important. Moving on to how to create a diversified portfolio. So once we've created a financial plan, and let's say it comes out that you need a rate of return of 6, 7, 8, 9%. From that point, what we do is we look at we use the financial plan as the backbone to determine what rate of return we need, and then that in turn determines how you build your portfolio. So a portfolio, a diversified portfolio is going to have 3 different asset classes within it. There's going to be a short-term bucket, a medium-term bucket, and a long-term bucket. The short-term bucket, what that consists of is things such as high-interest savings accounts. These are typically the most low-risk investments and are there to fund any short-term needs. Then your medium-term assets would be things such as bonds, long-short strategies, market-neutral strategies. These are there to fund anything between, if you have withdrawal needs from 3 to 5 years time period. And then a diversified portfolio should also have long-term investments as well. So things such as stocks, real estate, crypto, commodities such as gold and silver. And the combination of short, medium, and long-term investments, having the right mix of it is extremely important. So then the question becomes, what is the right mix? And the right mix varies from person to person. And it's determined from your financial plan. So let's say, for example, someone's approaching retirement. And retirement is in 2 to 3 years. Then you have to look at your portfolio. And the portfolio doesn't just mean looking at your investments such as RSPs or a pension. It also means looking at your house, looking at any rental property that you may have, and seeing how does that fit into my overall plan. So, for example, let's say you're heading into retirement and all your portfolio is in real estate tied into rental investments into rental market, but all of them have a mortgage on them. And the mortgage on them is and the rental income that's coming in is just covering the mortgages, then how will that fund your retirement? So then the question becomes, okay, is that the right investment for me as I'm heading into retirement? Because what I need is a source of income. So, so then the question becomes, okay, is that a short, medium, or long-term investment? Right. So, so as you approach, you have to kind of come up with a strategy. Do I look to sell at some point? Do I look to raise my medium-term investments? Do I look to raise my short-term investments? And that's where having a conversation with a financial advisor is key. So what we do is we will prepare, we will look at your overall, and that's what I meant here, that we will look at your overall complete picture and determine, what is it that we need to do to be able to fund your objectives. Because if the objective, at the end of the day, everyone, when I sit down with my clients, they tell me I want to make as much money as possible. But yeah, and for someone, yes, the real estate market, especially in Canada, has been a great market, and you can make a lot of money. But is it going to serve your purpose as you enter into retirement, especially if it's mortgaged up and leveraged up? Then the question is maybe, maybe not, right? So creating that right mix is essential in being able to service your objectives. There was a study done back in 2008, and what they looked at was, what are the primary drivers of generating returns in a portfolio? So what they did was they looked at sample portfolios from 1980 all the way up to 2008. And they looked at, is it asset allocation, which is the right mix between short, medium, and long-term investments that determines performance? Is it market timing that determines performance? Or is it really the picking the right stocks that determines performance? And the findings were actually shocking for a lot of people, that 94% of the returns are actually determined by having the right asset allocation in place. Only 4% comes in from having the right stocks, and just 2% from having the market, timing the market correctly. But if you were to think about it, what is it that people spend most of their time on when it comes to their investments? Most of the people spend their time trying to time the market as opposed to trying to find the right asset allocation. Meanwhile, 94% of the returns are actually generated from finding the right asset allocation. So I can't highlight the enough importance on having the right asset allocation in place. The second thing is, once you've determined what is it that your the right asset allocation is for you as an investor, the second most important thing is constantly rebalancing between the different asset classes that you have. So what I've got here is a very simple illustration over here, and that's asset one that you see in blue is stocks. Let's assume that there's an investor that only has two asset classes that they invest in. One in orange, that's bonds, and in blue, that's stocks. Let's say after doing their due diligence, they determine that the right asset allocation for them as investors is having 60% exposure in stocks and 40% exposure in bonds, which is typically considered to be a balanced portfolio in our line of work. So as the stock market goes up, what happens is that stocks become a larger and larger portion of your portfolio because they typically outgrow bonds. Bonds are interest-bearing investments that typically don't go up and down as the stock market does. They're very steady. So typically their returns are not as high as stocks either. So as the stock market continues to grow, someone who had a risk allocation of 60% stocks and 40% bonds may become more and more aggressive over time as the stock market continues to go up, and they may become, and their asset allocation may get up to 80% stocks and 20% bonds. So what would happen in that case is someone who started out as a medium or a balanced investor now has become a extremely aggressive investor. So at this time, it's extremely important to rebalance your portfolio. And how you do that is by taking profits and securing them into bonds. And so basically what you would do is you'd sell some stocks at that time and buy more bonds. And because we all know how the stock market works. As things, nothing goes up in a straight line. Things do come down. So anyone whose risk profile was something which was a lot more balanced in nature, in this scenario here would become a lot more aggressive. And if they haven't taken their profits, they would be exposed to very high losses at that time because 80% of their portfolio is exposed to the market at that time. So one of the most important things in making sure, especially as you approach retirement, is to make sure that you're constantly rebalancing your portfolio. And a lot of people ask me, how often do you do that? It's completely dependent on how the market is going. Sometimes you may have to do it in a matter of like twice a year. Sometimes you may not have to do it at all in a year. It all depends on your asset allocation. So it's extremely important to keep looking at that.
So at this time, Shayan, there's one question from Tariq. Tariq, could you spell out your question?
Yeah. Actually, I just want to trigger people to start putting in question in the chat. Okay, normally a layman is or common investor is not really stock market savvy, or does not really know why market or a particular stock is going up or down. And because of the impulsiveness of individual investor, mostly he or she is at a loss. So how about a strategy to invest in funds rather than in individual stocks as a long-term or as a safe option for people like who are near retirement?
That's a very good question. See, the thing is that a lot of people use mutual funds as a vehicle to invest, because picking individual stocks is not everyone's line of expertise. And I don't recommend most people, anyone does that, and unless they're very invested in the market and they're very financially savvy. But the thing is, even if you have mutual funds, there's different kinds of mutual funds. There are equity mutual funds, and these equity mutual funds, they are in a combination, they're a mixed bag of stocks within that mutual fund. They would have a balance, like for example, one of the really popular mutual funds in the US is called Fidelity Contra Fund. Very popular, you'll see it in most pension funds. And that mutual fund will have a combination of about 60 stocks in it. But what I'm talking about is, so you have that, and then there's also, those are equity mutual funds. Then you also have fixed income or bond mutual funds, right? Because when the market goes up, whether that equity mutual fund will go up in value. When the market comes down, that equity mutual fund will come down in value just as much as the market. Now, if all your money is in one fund or in two funds or three funds, and they're all equity mutual funds, then you're going to come up and down with the market. In order to diversify and not come down, because, for example, let's say someone's retired. They need $30,000 a year from their portfolio. And, the market comes down, similar to what happened in 2022. The market came down in value. At that time, whether you're invested in a mutual fund, whether you're invested in stocks, your portfolio will come down in value. The number one rule of investing is you don't sell when you're down in value, because then you realize a loss, right? A loss is not a loss until you realize a loss. For example, if you bought a house in Mississauga for $1 million, interest rates went up, and now it's worth $900,000. That's only if you sell that house. Most people, unless they're forced into selling, will not sell the house. They will wait till it goes back up in value. But if you're retired and you need $30,000 a year to live your lifestyle, then what are you going to do? You have to sell, right? So therefore, what I'm talking about here is having short-term and medium-term investments as well. Short-term investments would be when you look at your entire portfolio, say, hey, I've got this fund which is invested in stocks, and they manage it, they know when to buy, they know when to sell, they know what to invest in. But that stock will also that fund will also come down in value. It's also important to have another kind of fund which reacts negatively or reacts in an opposite way when the market comes down. So that's what I meant by having short-term and medium-term investments.
Good, thank you.
So going back to tips for asset allocation. As you get closer and closer to retirement, it is extremely important not to have balanced funds in your portfolio. What is a balanced fund? We talked about equity funds. A balanced fund is if you look at your portfolio and you see anything like a Fidelity Global Income Fund or Trimark Global Portfolio, managed portfolio. What that means is it is a combination of stocks and bonds. And what they are doing for you, typically in pension funds, you'll find a lot of balanced funds. What they are doing for you is they are automatically creating a portfolio which is looking at all three of these asset classes. They are doing it for you. They are great when you're saving money for retirement because it's a set it and forget it approach. You don't have to think about it. Someone's doing it for you. But as you get closer and closer to retirement, it's very important to be able to actually move out of these funds. Because again, going back to my example that let's say you need $30,000 a year to fund your retirement, if all your money is in a balanced fund, what will happen is that it has, so think of a balanced fund as this one big fund, right? And within it, they have cash, they have bonds, and they have stocks. When stocks come down, that entire balanced fund will come down in value. But what if you just separate the cash fund, the bond fund, and the equity fund? You just separate the three. Then even if the market comes down and your portfolio comes down in value, you still have areas that you can access within your portfolio to fund your withdrawals without having to realize losses. Does that make sense?
Yeah.
So number one tip that I can give anyone is have a look at your portfolios. If you're planning on retiring in the next 5 years or looking to, even if it's not retirement, you could have a short-term goal such as let's say you have an investment account and the goal is my kids, one of my kids is going to get married and I need $20, $30, $40, $50,000 for the kid's wedding, right? So in that case, that's a short-term goal. And it's going to happen in the next 1 to 2 years. Having the right investment plan for that is extremely important. Because if all the money is in a balanced fund and then guess what, in 2 years' time, the stock market's down, now you're not going to tell your kids that, hey, wait another year or so to get married, right? So being able to separate the short, medium, and long-term investments is very key at that point too. The role of a financial advisor is key in helping achieve financial independence. And how does that happen? Again, it goes down to a goal without a plan is just a wish. It's important for a financial advisor to have a conversation, understand your goals and objectives. Just like I said, having a conversation, hey, my son is getting married in a year or two. I want to make sure that I have money for that. I'm looking to buy a rental property in the next 1 year, and I want to make sure that my investments are kind of positioned in a way that I can do that. I'm looking to retire in 5 years. My daughter is going to university in a year. All these are goals and objectives. And having an understanding of that and then taking that to construct a financial plan, and being able to provide a roadmap and understand what rate of return you need is actually the role of a financial advisor. Then once that is done, creating the right mix between the three different buckets I talked about, constantly rebalancing on a semi-annual or an annual basis on a need for need basis. And the most important thing that I think, Tariq, you touched upon is the most important role that often gets overlooked is behavioral coaching. Because as investors, we go through these emotions. And this is in line with how the stock market works. Let's say you buy a stock or a fund. As things go up, emotions start to play a role. You start to get excited. The stock continues to go up, you become more excited, you go into the thrill phase. Then euphoric stage. As that starts to happen, that's actually the point of maximum financial risk. This is where portfolio rebalancing has a huge role to play, because this is emotions and stock market go hand in hand. You're not going to feel thrilled when the market is down. And as the market goes up, that's when it's important. If you recall, I talked about rebalancing right here. This is keep that slide I had open in mind. As the stock market is going up, guess what? Your equity exposure is becoming higher and higher and higher. If you don't take profits, what happens? The market comes down. So I'm going to keep flipping between a few slides. As the stock market starts to come down, now people start to feel anxiety. They start to feel depression, right? They start to feel worried, right? And how you avoid that is by constantly rebalancing your portfolio. And then typically the best time to buy, whether it's real estate, whether it's crypto, whether it's stocks, is when the market is at its bottom. But typically why people are not able to do that is because emotions come into place. And how you take the emotions out of it is by constantly rebalancing. Because on the flip side, when the markets are down, what's going to happen? I'm going to go back to that slide again. That now stocks would be a smaller portion of your portfolio, and the bonds are going to be a larger portion of your portfolio. And at that point, it would be a trigger point for us to just go into the market, sell some of your bonds and buy into the market at that point. So how we take the emotions out of investing is by constantly rebalancing your portfolio. So in short, if I was to just recap what I talked about today, is that it's extremely important to have a financial plan, know what your objectives are, and to invest accordingly. A lot of the times when I sit down with people and see what is it that, have a conversation with them and understand what their goals are, and then look at what they're invested in, a lot of the times there's a big dislocation between the two, right? An example is, again, like the one that I talked about is, I'm looking to fund my kid's wedding, but all my money is in a rental property. And I really don't have a lot of liquid assets. Then what's the plan? How are you going to do that? Are you going to sell something? Are you going to take a loan against it? Similarly, I want to pay for kids' education, and all my money is in the stock market, and they're going to go to school next year. Maybe it's not a good idea to have all the money in the stock market. Take some profits, raise some cash, have some cash on the side within the portfolio. Looking at different programs that exist, you know, how to use our ESPs in Canada, how to use our RSPs, how to use the IRA accounts, right? And then looking at, and then after that, it's important to come up with the right mix between between stocks, bonds, and mutual funds. Then also constantly rebalancing the portfolio. What we do here is at our firm is we manage investments, we do tax planning, we do retirement planning, we do corporate, business restructuring, education planning, estate. So we look at all the areas of wealth management, and I'm open to having a conversation. Any questions you may have, I'm like to open the floor for that.
So
Yeah.
to start with, there's a question Tariq posted actually, self-investing versus taking the help from advisor or going through advisor. So at the same time, I will ask you, combine these two questions. So for example, your own experience and your own track record, what is it? Is it in the positive territory, and how much is that? And so if you can combine your own experience versus why financial advisor is a better option than self-investing. If you can elaborate.
Than self-investing?
Yes.
If you're a self-investor that has tremendous amount of experience and can take emotions out of the picture, then do it yourself.
Yeah, that's why my question actually triggered from that perspective when you were showing that graph, different stages of stock moving up or down, because individual emotions come into play. And
they do. I'll give you an example. In 2022 was a very difficult year for the stock markets. The amount of calls I got from clients asking to go cash. It was at that time my role to talk to my clients and explain to them that this is not the right move. And having that, you know, conversation back and forth and being able to talk them out of it is what saved them a lot of money, because guess what? 2023 markets were up 20%.
Yeah.
If someone went into cash at that time, and if, then they missed out on returns. You know what the average rate of return of a self-investor is over the last 20 years? 2% annualized rate of return. You know why? Not because they're bad at picking stocks. It's because they typically sold them at the wrong time. It's the emotions that came into it.
Okay.
So that's where I think the role of a financial advisor is.
Okay. Another question came in. I invested 20 years ago in RRSP. You may be familiar with this in Canada. In Canada, it grew just 1%. I moved to USA a long time ago. What are my options? The question is from our colleague Waqar Ahmed of Computer Science.
Okay, that's a very complicated question. Are you a US tax person? Do you still have Canadian, are you still a Canadian resident for tax purposes? Are you paying taxes in Canada? This is not a simple question that I can answer without understanding the context.
Waqar, if you can open your mic and if you
No.
want to follow up from your question, you are free to do that.
Yeah, hello everyone.
Okay.
Thanks for taking my question. Yeah,
Mhm.
I moved to USA now a long time ago. I have a US citizenship now, and I am a
Mhm.
non-resident for Canada. I do not file anything in Canada because I don't have anything in Canada.
I
But
see. Okay.
there was
Okay.
a guy, there was a financial planner, Sati. He was a Pakistani guy. He was just, I don't know, like he just trapped us on the radio that invest through him. And I
Mhm.
invested good amount of money at that time when I was in Canada. And
Mhm.
now since I moved out of Canada, then whoever I call like the agent, they say that they cannot do anything until I am physically present in Ontario or something like that. So they cannot change my portfolio. So that
Yeah,
was a big,
most of the time,
yeah,
they
that's,
won't be able to change your portfolio because you've become a non-resident.
yeah, he says
Yeah.
that fly to Canada and then talk to us, and then we'll change some. I don't know whether they would be able to even change anything. But that was
So
like
this is
my understanding, that was a big mistake which I did. Like it did not grow at all. So
Mhm. Yeah. So see, what happens is that when someone there's rules regarding this. So if you are a Canadian and then you move to the US, then and your Canadian investments become we cannot make any change. We cannot touch them anymore. They have to
Locked.
remain as is. We can't make trades on them. We can't do anything. So typically, if your money's in an RSP, what I would do is if you're working right now, because if you were to take money out of the RSP, what that would mean is it would be counted as income.
yeah,
And
you have to
then
pay
as
tax.
US, you would have to declare that as income too, because in US you also have to declare your worldwide income.
Yep.
And then you'd owe tax on it. I would, yeah, it's not a good position to be in, but what I would do is probably wait till retirement and then take it all. Like depending on the size, you'd have to determine how to take that money out.
Yeah. So that will I like to me whenever I will retire, it will be that same amount of money I'll get which I invested 20 years ago. Let's say that.
Wow.
So
No,
at least your
that's
principal is
important.
intact.
Yeah.
But that,
Okay. So it's possible,
No, that's
Waqar, this question, actually your situation
I think
requires a little more conversation.
yeah. Too much
Shayan,
time.
are
Yeah,
you
we can
open?
talk. But
Okay, thank you.
Yep.
Shayan, are you open to talk to Waqar, for example, or anybody else if they call you for advice or
yeah, for sure.
so?
Yeah, definitely open. I can share my contact information.
Yeah, so could you put the slide where your contact information is right now while we are talking, and that people can see that?
I didn't put that on there, but what I can do is
You have on the
I
first
can,
page here. Okay.
yeah, I don't have my like what I can do is I can provide my email address and my contact information through.
Can you
So
add
you can
it
share it
right
in the
here?
group, I guess.
No,
Can-
let
can-
me share that. I have that information here.
Okay, okay.
I'll share.
So,
Yeah.
So I have another question, if you are done with that.
Go ahead, Tariq, with the question.
So, okay, can you elaborate on different types of investment account, individual investment accounts, like account with the margin capability, because that's something is very risky, but if you can elaborate on that.
Are we talking in Canada or in the US?
Doesn't it work same way in both markets?
So you want to talk about margin accounts?
Margin versus non-margin, and what are the benefit or risks?
Okay. So a margin account is when you're able to take a loan against your stocks or your mutual funds to be able to buy into the market. That's what a margin account is. A non-margin account is where you don't have the ability to take a loan against it. Why will people do a margin account is anytime you use leverage or loans to buy into an asset, it increases your ability to grow, right? It magnifies growth.
Yep.
Similarly, the opposite can also happen. When things come down, losses get magnified as well because you owe the money, you owe the interest expense, and you may have to do what's called a margin call, right?
Yep.
Why do people as you get closer and closer to retirement, it is advisable not to employ margin because you're increasing the risk of the portfolio. But in younger years and growth years, it can be a great tool. I'm going to go back to one of my slides, which is this one here. You know what so cash, I said, is a short-term asset. Medium is bonds and long is stocks or real estate. Margin can fall in this category, but it's got an expense to it in the form of a loan, right? So when things go down, and I'm going to go down to this slide here, when things go down, this is where margin, if you don't have cash, actual cash, you can use margin to buy into the market. And that's the goal of margin accounts. But in retirement, I'd say, as you approach retirement, I'd say start to move away from it. And then obviously the interest rates have what the rates are, all that has to be factored into.
Thank you. That's very good.
So I posted, Shayan, I posted your information in the chat box. Waqar, you can copy from the chat box, which is, I think, better readable.
Yeah.
Okay,
Yeah.
thank you.
Okay, all right. So,
Okay. Yeah. Yeah, that's anything else? Any other questions?
Not for me. Anyone else want to ask?
Yes, I will ask one question.
Mhm.
Sure.
Oh, मेरा ख्याल है मेरा हाँ Shayan, traditionally like people think that investing in property or having a house or second rental income is traditional as well as secure and safer if you can hold on to it long term. So we currently have a house in London, Ontario, and we are in a sort of a fix that should we rent it for another year and put it on the market next March, April, or should we just hold 2-3 months and don't rent it and put it out on this June, July, August, because the first rate cut is expected somewhere in end June, early July. So just like, it's not a professional advice, I will not hold you on this, but what's your feeling, gut reflection?
On the housing market?
Yeah.
So the longer you hold, the better it is, right? Because it also depends on when you purchased it, right? So if you
we purchased it in
in
July 2021 when the market was very hot.
Okay, yeah, and then since then the market's come down, and especially London and all of that area has been impacted a bit more. As long as the rental property is cash flow positive, I would hold on to it because it will come back at some point. If you're able to break even or in the next few months, then that's okay too. But it just comes down to cash flow positivity. That's what it is, right? And right now, most properties are not cash flow positive.
Okay, thank you. I got it.
Yeah, on this one, I can add one thing to Arshad bhai. I'm not that, know much, as Shian said, it all financial thing, but I just recently got for fun my real estate license to just, I love to do a lot of things around here and there. So I would suggest the same thing that based on my information, what I am getting it, it's better not to sell it if you're not paying from your pocket.
Mm-hmm.
Yeah, keep it if you can.
Thank you. Yeah.
Yeah.
So, Farooq, could you introduce yourself, please? Okay.
Farooq?
I think it was Farooq who was talking, right?
No, Fida.
Or Fida, it was Fida talking.
Fida was talking.
Okay, all right. I thought it is new member Farooq. Thank you very much, Shayan. I think we get to the end of it, and we have recorded this for our members' free time review, and we'll advertise this. And obviously, yeah, as you said, you are open to take personal calls from the members, and if you can help anyone, and if people are eager to take your services, I think you are open for that, right?
Perfect. Thank you so much, everybody.
Thank you. And
Thank
I'm
you. It was
stopping
very
the
good
recording.